In order to use the calls and puts, it does require margin, meaning this can't be used for accounts that are registered, such as a TFSA for Canadians or a 401k for Americans, I believe. But at the same time, it also calls and puts also allow you to hedge against potential changes in price that you don't expect that would cause your portfolio to see significant losses. For example, if the interest rates rise, many of the companies will not be able to pay their debt in the Russell 2000 small cap index. And the IEF is a fixed income vehicle that basically provides an inverse return on the yields of treasuries. And ever since coronavirus happened, the 10-year bond has been yielding very, very low returns, but it is obviously a far safer investment than equities or stocks because of the fact that it's backed by the US government and it doesn't move very much. So it took a rush of capital flew into the bond market and it left the equity market falling, along with rates, which were dropped by the Federal Reserve to allow for the government to very cheaply lend money out to businesses and essentially finance the recovery of the economy and the COVID stimulus payments. And that also leads to inflation, which takes away part of the net marginal interest rate, which we talked about earlier. And it's not good for bonds, especially bonds that are not protected by TIPS, which is inflation protected securities. That means that the inflation will eat into the profit margins of these 10-year bonds, and locking in a 10-year loss with a 3% yield and 4% inflation over that period is not an investment that's attractive to any type of investor, really. And despite the fact that it's not going to yield you major losses in the event that the market crashes, it's not going to provide you with a decent return on capital. And you can see that the IEF is inversely correlated to the TNX or the 10-year treasury yields. And when they drop the yields down to record lows over the last 10 years during the pandemic, the IEF, the ETF that I have puts on, increased up to record heights, and it was reached $121. Now, it slowly started declining as assets were transferred out of fixed income and bonds and into equities in search of higher returns and to take advantage of the recovering economy. Then the outflow of capital allowed for this depreciation in share price to likely around pre-COVID levels at the very highest. So how do you take advantage of that very likely drop in price? Well, by purchasing puts, you're allowed to take a short position, meaning you profit when the share price goes down. If the strike price is hit, similar to the calls, but on the way down. And right now, the value of the contracts for the IEF puts, which have a strike price of $118, are only 70 cents a contract. But in the event that the IEF drops even slightly to $110, like it did prior to the pandemic, that's a ninefold increase in value in the investment in these contracts. So a $100 investment will get you $900 if the price of this ETF returns to pre-pandemic levels, which is very likely. It's actually likely to decrease below pre-pandemic levels. And as you can see here, before people started loading up on the bonds during the pandemic, it was around $110 to $114. And if you pull up your options calculator here you can see that if it hits 110 to 115, then you're looking at a profit of around $700. So that's on the lower side. And at 115, you're only looking at a 100% return. That being said, or a 200% return. That being said, this is also a hedge against inflation, meaning if the economy starts to show signs of strength and the US dollar continues to be printed and printed at an increasing rate, and the inflation rates increase along with obviously the excess supply of money, then it will likely cause the IEF to fall regardless of the risk sentiment towards fixed income versus equities. But if equities continue to outperform other asset classes, especially commodities, or commodities especially outperforming fixed income along with equities, so that's high oil prices, high copper, aluminum prices, high agricultural prices, and tangible assets such as real estate offer a more attractive investment, especially because it's very cheap to borrow, then the IEF no longer looks like a suitable investment for risk adverse investors or investors looking for higher yields. So, for someone who's trying to protect their portfolio, a better alternative may be to simply buy puts on the long positions of their equities. So, if you were to buy a put on Synovus or an index like the TSX iShares XEG, then that means that if the broad market falls extensively, you'll be able to make money on the puts. And because the puts are predefined assets at risk, you know exactly how much money you stand to lose in the event that the market continues to rise. And what I usually do is I pair my puts, which are kind of like an insurance against your portfolio in case this happens. Then your puts may have a strike price at around there. And when it drops here, you're able to make enough money to offset some of your losses and then buy back in at a lower price, therefore preventing a major decline in your portfolio and your ability to achieve profitability over the long term. And it's not expensive to buy these puts. These puts could be $100 or $200, similar to the IEF puts, and they can return far more than the value that is invested. Like, for example, 7 times return on investment is not unreasonable for a $110 share price for the IEF. And I believe that retail investors should have access to these tools, especially as a way to prevent downside risk in their portfolio and to leverage the assets that they do have. Because options are multiplied by 100, that means that for every contract you buy, let's say it's a 15-cent contract like the BIR options, then BIR calls, then that means that it's going to cost $150 because it's multiplied by 100. And that multiple of 100 acts as leverage in the event that you do go past the strike price and achieve profitability. Then you can, if you want, exercise your shares, which would then give you up to 100 times the number of contracts, which are 2, and then you would buy the share price at the strike, which is you determine, and you start profiting once the share price goes above the strike plus the cost of the contract. So if it's a $7 strike price and the contract's $1, then you start profiting at $8. And once you get past $8, you may find it better to exercise your option, because options literally mean you have the option to exercise and convert your options contract into the number of shares times the number of contracts times 100. And for Birchcliff, that would be 15 contracts, so times 100. That would mean you're looking at 15,000 shares at $2.50. And if that share price rises to $3, then that 45-cent profit margin will be applied to all 15,000 shares. And if you don't have the money to exercise the option and get the dividend payments, you still have the option to sell the contract with its intrinsic value being somewhere around the price equivalent to the profits plus the original